Section 1. The Bitcoin Crossroads. A snapshot in time. Welcome. Today is December 15th, 2025. We stand at a critical juncture for Bitcoin. The digital asset has captured the world's attention for over a decade. It has moved from the fringes of finance to the portfolios of major institutions. Yet, even with this maturity, its future remains a subject of intense debate. Today, we will unpack the current state of Bitcoin. We will analyze the forces shaping its price and explore what might come next. Is this a moment of consolidation before the next major surge? Or are we seeing signs of a prolonged slowdown? The data tells a complex story, full of conflicting signals that pull the market in different directions. The numbers on the screen paint a picture of quiet turbulence. As of today, Bitcoin is trading at approximately $89,079. This represents a modest but notable 1% decline over the last 24 hours, from its previous perch, around $90,147. This price movement is not happening in a vacuum. It is part of a larger trend that has seen the asset slide from recent highs, causing a ripple of concern among traders who watch every tick of the chart. This slight downturn reflects a market that is hesitating. It is a market digesting recent gains and questioning its next directional move. The sentiment is cautious, a stark contrast to the unbridled optimism that characterized earlier phases of this cycle. To understand where we are, we must remember where we've been. It was only a couple of months ago, on October 6, 2025, that Bitcoin carved out a spectacular new all-time high. The price soared to an incredible $126,210.50, a moment that seemed to confirm the most bullish predictions. However, the market has since pulled back significantly from that peak. The current price of around $89,000 places Bitcoin nearly 29% below that record high. This correction has left many investors wondering if the peak is behind us for now. Section 2. Anchor or FOMO. Navigating Bitcoin's future. Our goal today is to cut through the noise. The crypto world is filled with extreme opinions. Super bulls predicting moonshots, permanent bears forecasting doom. We will set those narratives aside. This analysis is framed around a core conflict: anchor versus FOMO. Anchor represents the forces pulling the price down or holding it steady. Weakening institutional demand, regulatory concerns, profit-taking. It is the weight of the market, the gravity that prevents prices from running away. On the other side of this conflict is FOMO, the fear of missing out. This is the powerful psychological force that has fueled Bitcoin's most explosive rallies. Supply scarcity promise of becoming digital gold rush of new investors wanting a piece of the action. FOMO represents the potential for a sudden surge, a breakout that leaves cautious investors behind. Our objective is to examine the data supporting both the anchor and the FOMO scenarios. By understanding the strength of each, we can better anticipate the market's next major move. It's a tug of war, and the winner will determine Bitcoin's trajectory in 2026. To achieve this clarity, we will focus on three key areas. First, we will provide a detailed look at the current market drivers, technical indicators, the options market, behavior of retail traders, behavior of institutional traders. We will explain complex concepts like options gamma in simple terms to show how market structure itself can create volatility. Second, we will analyze the bigger picture. ETF flows, accumulation by major players like MicroStrategy, macroeconomic landscape, including central bank policies. Finally, we will lay out the near-term and long-term scenarios for Bitcoin. We will summarize the price predictions from leading analysts, range from cautious to incredibly optimistic. We will explore the bull case for a supercycle that pushes prices to new highs. We will explore the bear case for a significant shock or a prolonged consolidation period. By the end of this report, you will have a clear, fact-based framework for understanding Bitcoin's position today on December 15th, 2025. You will be equipped with the knowledge to evaluate the competing forces of anchor and FOMO and to watch the key indicators that will signal Bitcoin's next move. Section 1. The anatomy of a price slide. Let's dissect today's price action more closely. The move from over $90,000 to around $89,079 is more than just a number on a screen. It tells a story about market sentiment. This recent slide has seen Bitcoin dip toward the $86,000 mark, a level traders are watching with intense focus. This is not a random fluctuation. It is a calculated test of a key support zone. When prices approach such a threshold, the market holds its breath. Buyers step in, creating a floor. Sellers may panic and accelerate the decline. The downward pressure comes from a confluence of factors. Primary concern: the flow of money into Bitcoin ETFs. ETFs were a major catalyst for earlier surges, but recent inflows have been underwhelming. That weakness creates a vacuum of upward momentum. Without institutional tailwinds, price is more vulnerable to short-term traders and volatility. Section 2. Liquidations and trader apprehension. A key factor contributing to the recent price slide is the domino effect of liquidations in the derivatives market. When traders use leverage, they are essentially borrowing funds to amplify their bets on Bitcoin's price direction. If the price moves against their position, their broker can be forced to automatically close the position to prevent further losses. This is called a liquidation. As Bitcoin's price began to slide from its perch above $90,000, it triggered a cascade of these forced sales from long position holders. Each liquidation adds more selling pressure to the market, pushing the price down further, and in turn, triggering even more liquidations in a vicious cycle. This mechanical selling pressure creates a palpable sense of apprehension among traders. The fear of being caught in one of these liquidation cascades makes market participants more cautious. They become less willing to take on new leveraged long positions and more inclined to take profits off the table quickly. In fact, on December 12th, the market saw total net outflows of approximately $154.2 million from Bitcoin exchange-traded products, which signals that, on aggregate, institutional funds are not just pausing their buying, they are actively reducing their exposure. The current mood is therefore not one of panic, but of deep-seated apprehension. Traders are on high alert, fully aware that a break below the crucial $86,000 support could trigger another, more severe wave of liquidations. Section 3. The gravity of the options market. Beyond the immediate spot market, another powerful force is shaping Bitcoin's price: the options market. As of today, total open interest in Bitcoin options sits at a staggering $55.76 billion. This massive pool of capital acts like a gravitational field, influencing price movements as traders and market makers manage their positions. Right now, there is enormous positioning around the $100,000 strike price. This psychological barrier, reinforced by billions in derivatives, acts as a powerful magnet and a formidable point of resistance. This concentration creates a phenomenon known as a gamma band. The current structure has created a gamma band between $86,000 and $110,000. Think of it like a pinball machine. Bitcoin is the ball, and the gamma band boundary at $86,000 and the gamma band boundary at $110,000 are the bumpers. As price nears the lower bumper at $86,000, hedging can create buying pressure, pushing it back up. As it nears the upper bumper at $110,000, hedging can create selling pressure, pushing it back down. The options market is effectively building the walls of the cage that the spot price is trapped in. One of the most significant narratives of the last 2 years has been the arrival of institutional capital through spot Bitcoin ETFs. During previous accumulation phases, these ETFs acted as a powerful engine for price appreciation. Historically, we saw daily net inflows consistently start around the $500 million mark, often ramping up to an astonishing $1 billion per day during periods of peak demand. This was the FOMO engine in full effect, pulling billions of dollars off the sidelines. However, the picture today, on December 15, 2025, looks markedly different. The once roaring river of institutional cash has slowed to a trickle. Current daily net inflows are hovering around a mere $54.8 million. This figure represents a dramatic deceleration in demand and is a primary source of the anchor weighing on the market. This slowdown signals a clear shift in institutional sentiment from aggressive accumulation to cautious observation. Without the powerful tailwind of massive ETF inflows, the market has lost a key pillar of support, making it far more susceptible to the bearish pressures we've discussed. In stark contrast to the wavering sentiment seen in the broader ETF market, one institutional player stands out for its relentless and unwavering conviction: MicroStrategy. Led by its outspoken executive chairman Michael Saylor, while other institutions may be pausing or even reducing their exposure, MicroStrategy continues its aggressive accumulation strategy without hesitation. Just recently, the company announced the purchase of another 10,645 BTC. This latest acquisition brings its total treasury holdings to an unprecedented level. With its latest purchase, the company's hoard has now grown to a staggering 671,268 BTC. To put that into perspective, this single company holds over 3% of the entire current circulating supply of Bitcoin. The company has repeatedly raised billions of dollars through the issuance of convertible notes, other stock instruments, with the explicit purpose of using the proceeds to buy more Bitcoin. For instance, during Q2 2025 alone, MicroStrategy raised $10.5 billion. That capital was directly channeled into acquiring 22,048 BTC. While the broader market frets about weakening ETF flows and potential downside, MicroStrategy acts as a consistent, price-insensitive buyer. As we stand here in December 2025, the institutional landscape is therefore split. The broad, cautious sentiment of the ETF market on one side, and the focused, aggressive accumulation of this corporate whale on the other. A more powerful long-term force is quietly at play: Bitcoin's unchangeable supply dynamics. The core design of Bitcoin is one of absolute scarcity. There will only ever be 21 million coins. As of today, the circulating supply stands at about 19.96 million BTC. This means that over 95% of all the Bitcoin that will ever exist has already been mined and is in circulation. New coins are released to miners as a reward, but this reward is cut in half approximately every 4 years, an event known as the halving. And the most recent one in 2024 further choked the flow of new supply. Since the launch of spot Bitcoin ETFs in January 2024, a structural supply imbalance has become deeply embedded in the market. Institutional entities have collectively acquired over 1,500,000 Bitcoin. During that same period, the Bitcoin network only produced approximately 300,000 new coins. This means that demand from these large players has outstripped new supply by a factor of 5 to 1. This supply-demand dynamic is the most powerful argument for the FOMO case. This imbalance is a coiled spring, and many believe it is only a matter of time before it uncoils with explosive force. On the bullish end of the spectrum, some major financial institutions are forecasting a continued powerful uptrend. Standard Chartered, for instance, has projected that Bitcoin could reach $300,000 by the end of 2026. Similarly, the investment firm Bernstein maintains a target of $200,000 by early 2026. Most analysts have placed their 2026 Bitcoin price forecast in a range between $85,000 as a base case and $150,000 as a bull case. Long-term predictions are even more optimistic. Visionaries like Jack Dorsey, Cathie Wood, have famously predicted that Bitcoin could exceed $1 million by 2030. However, the path to these fortunes is littered with risks. The anchor scenario is not just about weak ETF flows. It also involves very real security threats. North Korean hackers, for example, are reportedly running daily crypto scams using fake Zoom meetings and compromised Telegram accounts to trick victims into downloading malware, leading to hundreds of millions in losses. A single, large-scale security breach involving a major exchange or custodian could trigger a crisis of confidence and a sharp market sell-off. Tug-of-war visual. Anchor labeled weak ETF flows, macro risks, versus rocket labeled supply shock micro-strategy. The anchor scenario is defined by the forces holding the price in check. This path suggests a continuation of sideways price action, building a base in the $80,000 to $100,000 range. It is a future of moderate upside, but one that tests the patience of even the most devoted bulls. On the other side of this tug-of-war is the FOMO scenario. The market quickly breaks through the psychological $100,000 barrier. It begins its charge toward analyst targets, $150,000, $200,000, or even higher. Immediate support, $85,000 to $88,000. Critical line in the sand, $74,000. First hurdle, $90,000 to $94,000. Next barrier, $100,000. Major technical resistance, 50-week moving average, $102,000. Daily ETF flow numbers, options market and gamma shifts, macroeconomic events, e.g. Bank of Japan decision, large-scale accumulation, MicroStrategy and similar buyers, major security incidents or hacks. Bitcoin stands at a crossroads. Market is balanced between institutional caution and a pending supply crisis. 2026 could be a shock or a supercycle. For now, neutral but tense. A trend-defining move is likely on the horizon,